My 2026 portfolio is built for survival, not excitement. It's built and designed to survive pretty much everything that usually kills investors, which is boredom, fear, and even stupidity. Buying into hyped up stocks and then losing a lot of money. I've worked on this portfolio for about 3 weeks in December, and this is the results, 25 names. This is at the core very different from what we had in 2025. This is my eToro portfolio here, and in 2025, as you can see here, we gained 38% pre-dividends, which is very good compared to the S&P of 16 to 17%. I mean, that's pretty amazing. And I'm very happy with this result, but this could have been much better if I was able to manage it better. The problem wasn't the strategy that I was using. I think the strategy that I was using is far more superior, but is meant for someone who does this full time as a money manager. And maybe I will become a full-time money manager sometime in the future, but right now I am not. I'm just mostly investing my money and letting it giving me returns passively. I'm not that active, and I don't believe in over trading and flopping, flip flopping every single quarter with most of the vast majority of your positions, and I think that's bad. Over trading is bad. That's my belief. But I did miss a lot of opportunities just because I wasn't paying enough attention to the stocks that I had, the price movements, and the strategy itself was meant to be basically buying low and selling high. So as I was buying low, that part I was doing very well, but I wasn't selling exactly at the right moments. For example, here I have left from 2024 actually Alibaba. Alibaba, if you take a look at the graph here, it bottomed out in 2022, had a long stretch of just bleeding out again before retesting, and then in 2024 it started to go up. But the way it's gone up is pretty much violent upsides in a short period of time. And basically, if you missed these periods, you would not been able to take profits successfully, because I mean, look at this. If you didn't take profits in these few months here, the stock went down again by 32%. So it doesn't make sense. Actually, I took profits here after it went up vertically, and then I added some more here in July 2025. Let's take a look at the positions to see if I still, yeah. So here 07 is the month. 9th of July, I added 1.9% to the position after it's gone sideways and down for a while. So, but what I missed was this run up here again, like 1.5 months or 2 months or so, and I was just very busy. And because of that, I just have to hold it now before being able to take a bunch of profits. Yes, it's probably gonna break 190, but I would have rather taken profits here after this move run up here, and maybe add a little bit more recently as it went down and retested here at 147. I mean, look at this classic going up, rejects this level here of 147, goes back down to retest, and then here in last trading session we had a 6% jump, which is, I mean, a sign that it's ready to go up again. But yeah, anyway, what I want to say here is that going forward into 2026, we're gonna have only 25 positions, and 20 of them, so the vast majority of the positions, are non-trading positions. This is stuff that I bought low, but I do not plan on selling them. So only about 5 positions here in this portfolio are gonna be stuff that I trade. So Adobe, 20% allocation right now. 20% is huge, but it's kind of time. It's time to buy it, and pretty much the reason that it's the number one position in my portfolio and with such a high weight allocated to it is because, well, this has been going sideways for 5 years, which for a stock, super high quality stock like Adobe, it matters a lot. The valuation compression is very real. They did a lot of buybacks in this time, and they did a lot of top line growth in this time. So the valuation underneath the stock price has been going down and down and down. And then the stock price did a lot of damage to the valuation as well. We have here a top of 635, let's say, in February 2024. And 2 years later, we're down almost 50% still. Just in December, we were touching basically down 50% since then. Since the all-time high from 2021, we're still down more than 50%. So what are my plans with this top position? Basically, I'm not going to touch it. For now, I'm not going to add to it. All of my positions are already completely set up. All of the money is deployed. I have about 0% in my cash balance. So I have nothing else to sell to add here. Because as you can see here, only Alibaba is a potential sell in about 3 to 4 months. And then I'll have some firepower, maybe 4 to 5% allocation. But I'm not going to be adding to Adobe. Um, Basically, Adobe is one of the candidates that I'm going to be trimming down when the opportunity comes. If this moves 40 to 60% up, the weight is going to become almost 30%. And that's going to be a perfect opportunity to trim and take profits. So we're going to be looking. I'm not sure when that's going to happen, obviously, but if it happens, I don't know, in 2 months, then yeah, I'll know exactly what to buy because I already have a bunch of positions that I want to allocate some more to them. But if it happens in 12 months, I'm not going to know what I'm going to do from today because it will depend a lot on the landscape of the market in general and the individual stocks that I'm already invested in. So, for example, financial services. This is a trading stock. It's down 73%, more than 70% since the top from not even that long ago, this year. So we can put the graph here to show its last 12 months, and we can see the top here, and it's down 72%. So the first trimming that I'm going to be doing with Baba and Adobe probably is going to go a little bit more capital into Fiserv because this is such a ridiculous drawdown in a such high quality company that has a decent vertical mode and also wide horizontal mode. That, I mean, 70%, I mean, just it's completely ridiculous. So I want to build up this position a little bit more, maybe 78%, and I'm gonna be happy. Trim a little bit from Alibaba when it pops up again, retract like 1 or 2% and add it to Fiserv. And then when Adobe moves, it's gonna move and we'll see then. But Novo Nordisk here is also 10% weight, which is the second highest. And this is also a trading stock, but this is it's gonna be a very slow mover. This is in the healthcare industry, and these things do not re-rate as violently as some other sectors and industries. This is basically just going to be a slow creep to the upside in price. And also, I mean, look at this. When you take a look at the all-time graph, I mean, just goes up almost parabolically in the last couple of years, and then it comes crashing down to earth again to this period there where it looks like it was almost going sideways for a couple of years, which actually it did. 2021 to 2022, basically going sideways. Yeah. So a lot of activity here during these years, not going up a lot, not going down either. And it seems like we stopped around this area as well at the price point. So it looks like a classical line of resistance at this price point. But obviously the valuation is completely different now. Why? Because they had a lot of top line growth during these years with their weight loss drugs. And they retained a lot of that revenue in the top line. So the company is completely different now than it was a couple of years ago. Let's just take a quick look. Adobe, not Adobe, Novo Nordisk. Forward P of 15. I mean, this is just ridiculous for the type of company that this is. I mean, yeah, it was flatlining almost for a little bit for a couple of years here, and then they put out a new drug on the market, and they went from $100 billion of their Danish currency. They tripled that. Trailing 12 months, they are doing 300 billion. So even before, this company was very, very high quality. I mean, look at this operating margins, even 10 years ago, 43%, today, 48%, gross margins over 80%. If you told me these type of margins and you had me guessing what type of company, I would definitely tell you it's just going to be some sort of either financial company like Visa or MasterCard, or it's going to be like software as a service, maybe Facebook, maybe Microsoft. But yeah, I would never suspect that this is not even a biotech company. This is just a drug manufacturer. It does have some biotechnology traits, but this is mainly a drug manufacturer. That's why they pretty much stopped their repurchases, their stock buybacks, because they focus on expanding their capacity to produce these kind of drugs. So they're investing a lot in capex, and this is actually a very good sign for me. Every time they do the right thing, which is not being greedy, not being stupid, and not bowing down to shareholders by pouring money into dividends and buyback, I'm happy. I'm happy to see that they are thinking about the future, expanding their business without going into debt. Oh, this is perfect. Yeah, I don't need buybacks right now. Yeah, sure, the stock price is not going to move much, but I don't care. I'm planning to keep it for a couple of years. So this is a trading stock. Why? Because it's not a hardcore type of buy it and hold it forever type of company. It's still going to have competition. It's not a pure toll booth. It's not a pure infrastructure type of company that I basically have in the rest of my portfolio when it comes to buy and hold for a very long time. But yeah, let's move on. Next stock that I'm going to be trading is going to be Trade Desk. This is also down more than 70%, and it is also a very high quality company. So as you can see here, just price going sideways. Yeah, sure, it has violent dips, going up 50% in just one day in 2021, and then 65% in 2022. So this can re-rate very violently. So we are expecting these type of moves. Why? Because that's the nature of the stock. Once you understand the type of business that these guys are in, so they're in the advertising business. Once the flow of money from the advertisers starts to come in violently again, then it can have these kind of re-ratings where it just goes up 60% or more in a day. With Novo Nordisk, this is not going to happen. It's just going to be a slow creep up over time, going up and down, like it was before here in history. So let's remove the mania part. So as you can see here, going up nicely, something like this, okay? I'm expecting something like this. A little bit faster. Why? Because the stock is down so much. So not as fast as it went from 2022 to up to the top here in 2 years, but something a little bit faster than it was doing prior. So that's the expectations that I have with this stock. I'm just going to trim little by little by little over time. I'm not going to be taking huge amounts of profits fast like I will be with the Trade Desk. So as you can see here, it has all types of price action, going up rapidly over long periods of time, and also sharp drawdowns, falling knife type of stuff, minus 66% in, was that 4 months? Let's just say 5 months. And then since the top in December 24, so a little bit over a year ago, we are down 73%. But I really like the entry point here. I'm not going to go into technicals, but just by looking at the graph, I really feel like it's an excellent entry point here. But also we have to take a look at the numbers and valuation. When I take a look at the graph, it's just more like a feeling type of stuff. But the raw numbers are going to give us the proof that we have entered at a very good price point. So in 2020, the forward PE was up at around 170 times, which is something absurd and crazy. I would never buy such a thing at such a valuation. A lot of people got hurt back then. And I mean, what happens when you buy at such high valuations? You're just going to go sideways for many, many years. And sometimes you're going to be up 50%, sometimes you're going to be down 50%, like what you have here. So, for example, let's say you bought 5 years ago in 2021. At some point, you're going to be up 50% as you were here in 2022, 2024. But if you don't trade it, if you don't take profits, if you just invested because you thought it was a good investment, I mean, surprise, now you're down 50% again. And now you're probably going to have to wait 6, 12 months more just to get back to your original investment. And I mean, if you put the Spider ETF, the S&P is going up and up and up, creeping up over time. So it's very, very hard to beat the market. And especially with these kind of picks that are very bad, buying at ridiculous valuations. I mean, you're just going to hurt yourself. Your portfolio is just going to die down basically over time. And it's just going to be a slow decay, and it's going to be a nasty one. But yeah, forward PE 19, which is very, very good for this type of stock. Why? Because it's still growing more than 20% consistently. I mean, look at this. Trailing 12 months, 21%, 2024, 25%, 23%, 32, 43, 20. I mean, this company is growing, okay? And it has been, and it's not going to stop growing anytime soon. It's going to have quite a bit of run. It's not, the runway is not huge and it's not very long probably, but until it's spent, until it's exhausted, we're looking at probably a few more years, at least 3, 4, 5 years. And then the margins are going to kick in. This already has very nice margins, 79% gross margins, 19% operating margins. It can do a lot better over time, so it can improve profit and free cash flow margins. Then you're just going to get returns from not the top line growth, but the company buying back its own shares, maybe paying out a dividend, stuff like that. Yeah, the balance sheet, I'm not going to go analyzing individual stocks in this video, but yeah. This was another, so we have Adobe as a trading position, Novo Nordisk as a slow stock to creep up, and we're going to slowly take money from it over time and reallocate. And this is going to remain around 10% as a position, but as it goes to 11, 12, I'm going to cut from it, and then I'm gonna let it grow again, and then I'm gonna cut again. So Alibaba here, it's at 10%. Once it reaches 11, 12, I'm gonna trim it again and put it in something like ServiceNow maybe, which is a very core holding that I will probably never sell, or maybe Fiserv if it's down still so much. But then we have the trade desk, which is around at around 2.7% weight. Let's just call it 3%. This can re-rate violently and move up by a lot. And even if it drops by 50%, which is very extremely unlikely to happen because the valuations are so ridiculously low, it's not going to hurt our portfolio. But when it does re-rate violently, and it can give us in a very short period of time 40, 60, maybe even 80% or more, it can contribute with a lot of gains to the overall portfolio. And then we have Paycom. This is not a buy and hold forever. This is also something that's going to creep up over time, and I'm just going to look to replace this with something else at some point. And then we have two other small positions that are basically working as a single position, which is Key Food Technology and Finvolution. These are definitely not companies that I'm looking to hold for a long time, but these can bring a lot of upside to our portfolio in 2026. 4P of only 3%, dividend yield of 8%, which is not bad, but the total shareholder return is about 20%. So let's take a look here at ratios. Total shareholder return 18% going forward. This is ridiculous. I mean, no, not going forward. This is trailing 12 months, 18%. At these prices, from today's prices, it's probably more than 20%. But anyway, 4P of 3. It doesn't need a lot of things to go well for this type of stock to contribute with a lot of gains to our portfolio. I mean, these can definitely double over the next 12 months. Let's take a look at market cap for a bit. Yeah, went down from in this last year, 2025, 6.3 billion at the top, and now we're looking at 2.5 billion. So steep drawdown, and I like the floor that we bought it here at 2.5, 2.5, 2.5. Yeah, I really like the entry point here. And this is like a nuclear option. These together make 2.5%. They can become 6 or 7% or more over time if we let them, but I'm not going to let them. And yeah, this was basically the trading part of my portfolio. And the rest are basically just solid stocks that I picked from my own investable portfolio, investable universe, sorry, and stocks that were down significantly. So I'm not just going to sprinkle 2 to 3% with names that are cute. Okay, this portfolio is not made to be exciting or be cute or make me feel good or make anyone feel good. This is designed to outperform. Okay, so let's take a look here. I'm gonna open a new window. ServiceNow. Okay, this is the first top position, 7% of the category that I'm gonna be buying and never selling. So now let's take a look at now. ServiceNow. It's down about 32%. As you can see here, it looks like it kind of bottomed at 144, and we went through a longer stretch down at these kind of levels just to retest. And I think it just wants to retest this level. Maybe we'll touch it, maybe not, but I don't really care if we do. We are down currently 34% from all-time high, which is great for this type of company. Exactly the entry point that I want. Oh, and also one trading stock, Fiserv. I'm not sure if I mentioned this, but yeah, this is forward price to earnings of 8 or so. Right now it's at P of 10. This is down 72%. This is amazing. I'm going to be looking to trim Alibaba first and add some more to it because this is like a springed up coil that's just going to pop in many people's faces. But yeah, Verisk Analytics is another company that I'm going to be not selling for many, many years to come unless there are some other huge opportunities in the same type of company, which is very deep in vertical mode. Down 31%. Very glad that I bought this. Had the opportunity to buy it. Viva Systems, again, very deep in vertical mode. Still down from 2021 highs from the SaaS mania. 35% down since then. But recently it's had a very steep drop. 28%. Great entry point. This is the type of company that can re-rate violently, but I mostly do not plan on selling. This is just going to creep up over time, and it's probably going to outperform the S&P nicely. So even these other positions that I do not plan on trading, they will still outperform. So Qualys has been going sideways for 5 years now. Slight uptrend, as you can see here. Look at this, 96 in 2021, and then we had 102, and then 120, 120 again, 123. It's been going sideways for a very long time, but yeah, it's slightly uptrending. This it's not going to be a very exciting type of stock, but it's just going to be a rock solid ballast that is going to hold everything together in my portfolio. Next, Thomson Reuters. Thomson Reuters, we bought this at a significant discount as well. 39% up, 40% almost down. How much are we down on? 35%. So yeah, we didn't buy it perfectly, but it's very, I like it. I love the entry point. So yeah, this is one of kind of the same type of stock like Verisk Analytics. This is not something that I'm ever gonna be selling, and this is gonna be a rock in a mountain in my portfolio. It's gonna hold everything together in times of stress and times of panic as well. Automatic data processing. This is down 22%, more than 22%. Very, very rare dip in ADP. ADP normally doesn't go down more than 20% or so. Very rare as well. As you can see here, we found like one dip of 20% or so. Yeah, usually when it dips about 20% or less. And now we have not only a dip of more than 20%, but also quite a bit of time. So if we go back, we have to go back about 5 years, and we're at the same kind of price level. So underneath, the stock has been growing nicely. ADP, this is just keeping up with inflation in the top line. 7%, actually a little bit more. 7, 7.5, 6%, 8%, 7%. So quite a bit more than inflation levels. Growing up nicely, and then also this is a habitual buybacker of shares. Not huge amounts of in terms of percentages, because the stock is not that cheap, it's expensive, but it is buyback. It is doing buybacks consistently, and this is what we want from our core part of the portfolio. And then we have other stuff that we bought. Copart, FDS, Intuit. I managed to buy this in the last trading session. Basically, this is a fresh edition. Manhattan Associates, Gartner, Nice. I mean, Nice. Let's take a look at Nice. This has been bleeding for about 6 years or so. Another SaaS, software as a service, but it does a lot more than that. I mean, look at this. Down 64% over many, many years. This is a mandatory stock that I want to add more to it once I trim from Alibaba. This and also Market Access. Market Access Holdings has been bleeding out. Kind of the same situation for many, many years. The top was in 2020. This is a very important stock for the bond market. Yeah, it's going down, down, and down, but less and less over time, especially since 2022. It's down only 21%. Compare that to 2020 top to the bottom of 2022, 58%. So yeah, it's slowing down a lot in the bleeding, but yeah, when this starts to re-rate and start to go higher, I don't want to miss it. So again, I'm going to be looking to add more to Market Access and Nice, the first retrimming that I do. So hopefully, yeah, these blow up. Either Adobe or Fiserv or Alibaba goes up again and allows me to buy some more of these, Market Access and Nice. So yeah, or maybe some of these smaller bombs, they go nuclear and they double up quickly, and maybe I'll just get rid of them altogether. But yeah, this was kind of it in terms of strategy and plans. What is the strategy? Let's recap. So basically is trading much fewer names, 4 to 5 names, Adobe, Fiserv, Novo Nordisk over longer period of time. Alibaba, this is a 2024 play, so much older, that we still have. So right now we're just going to be retrimming from that. And then the trade desk as well. And then these two bad boys here. And then the rest is just stuff that I'm not going to be selling in many years to come. I bought them at a steep discount, and I'm just going to not touch them unless I can swap them out with some other type of similar company. So for example, Thomson Reuters right now is down 40%, but something like Relics is down less. Let's just say I had Relics that was down only 15% or so, and we had Thomson Reuters down 48%, 39% to 40%. Now, that's going to be in a very attractive change of positions, going from down 15% to something like this, which is very similar. I mean, these companies kind of do the same kind of thing, but in terms of philosophy, but yeah, that's why they move in tandem, they move together as well. Actually, kind of all of Verisk as well. In terms of philosophy, these are very similar type of companies, and pretty much everything that you find in here are gonna have the same kind of graph. FDS as well. They are very highly related. The correlation is huge. Gartner. So I had quite a huge opportunity going into 2025, buying all of these companies at a steep discount. So I'm very happy about my portfolio going forward. Everything was bought very low to decently priced. And even not touching this portfolio for about 2 years, I expect to do some massive outperformance. But anyway, yeah, we'll see. I'm gonna update on the overall portfolio in about 6 months, or when I do some kind of significant move. Maybe when Adobe pops up, I'll do an update. What am I gonna buy then when I trim it? But yeah, anyway, good luck in 2026, and see you soon.